As a Singaporean, I should be loyal to my country. So from now on, I'm just gonna buy all Singapore stocks. Okay, but I'm just kidding. Before you go all out screaming at me saying, are you telling me we cannot buy Singapore stocks at all? Okay, let me share with you. So for myself, I'm not saying that we cannot buy Singapore stocks at all, but for myself, I only look at, in general, the three local banks as well as the REITs, and that's all. So some of you may then ask me, okay, if I don't like the individual stocks that are listed on the SGX, then how about buying the ETF that tracks the STI index? So in today's video, I'm going to share with you more about buying STI index and why I personally don't invest in the STI index. So why do Singapore investors like to invest in the STI index? So many new Singaporean investors, they like to start off their investing journey by investing in this STI index. And one of the strongest reasons as to why they choose to do so is because of local bias, or we can also call it national bias. So this means that there is this familiarity that is associated with the Singapore companies, and this familiarity distorts our expectations of risk and returns of the investment in the local market. So some also feel that because these Singapore companies are not distant from us and are just within our sight or within our reach, so it feels safer to actually invest in the Singapore market. Okay, so even if they are still young, or perhaps they're actually just still looking for growth investing, they still started out investing in the STI index. So in today's sharing, I'm going to focus primarily on the perspective of growth investing. Let's take a look at the STI index price chart. So firstly, we can see that the STI index does not have a very nice upward sloping shape, unlike the S&P 500 or the Dow Jones or Nasdaq index. So instead, what we see here is that the prices are actually moving in a cyclical manner. So what is the implication of this for growth investors? If we invest in the STI index, the buy and hold for the very long term of 10 years or 20 years strategy is not the optimal strategy to use in this scenario for STI index. Okay, this is because your portfolio will be going through the cycles with positive returns on some days, and on some days you have negative returns. If you want to understand more in detail, you can click on the link above and check out our other video sharing on why having a bag of investing strategies matter, in which we explain more in detail on a strategy that you can use to boost your returns if you are looking to invest in a cyclical stock or a cyclical ETF. And if you are an investor looking for income investing, you can also check out that video, as we also covered what many income investors miss out on, which leads to lower returns for them. And number two, you need to pay even more attention to the price that you buy, because your returns are highly dependent on your purchase price in this case. Okay, because if you look at those stocks or index funds that have a general upward trend over the long run, so even for those kind, right, even if you happen to buy at a rather high price, you can still hold on to your position longer over the long term, say 10 years, 20 years, and the prices will continue to rally up. But for stocks or index funds like the STI index, if you buy them at a price, say near the top, say around 3,300 in this case, your upside potential is greatly reduced. Because there is a strong resistance, something like a price ceiling for these cyclical stocks and index funds, and the makeup of the STI is such that the majority of it consists of property and the bank-related counters. And no one knows when this strong resistance will be broken. So if you miss out on a good buying and selling point, you have to wait until the cycle ends to buy it or to sell it at a good price again. And that is on average at least 2 years based on the past historical prices. So this is why the STI index is not added into my watch list, as it will take very long for me to grow my capital. So why is this happening? Why does the STI index not move like the US market indices? So let's take a look at the composition of the STI index. As at 18 August, the STI index is very heavily weighted in the banks industry group, which comprises of the 3 local banks at about 43%. So the banking industry, as we all know, is a cyclical industry, and therefore we can expect to see that the STI index to have a similar cyclical price movement. And here we see that the fourth largest component is Singtel, which has not been performing well. Okay, and the remaining components, they have very small weighting individually. Now, most of us have a common constraint, which is that we have limited capital to invest. Imagine today if you have a budget of just $10 to purchase the ingredients to cook up a sumptuous meal for 2 people. How would you do it? You would probably have to think carefully whether buying this ingredient is necessary or not, or whether that ingredient adds value to the meal. So the same goes for investing with a limited capital. So today, if I'm looking to invest in index ETFs for growth investing, I'll rather look at the US market. So here are some charts of the US indices. And if you're looking for better than average market returns, you can look beyond index ETFs. So you can also check out our video, You Can Do More Than Investing in Index ETFs to find out more. So that's the end of today's sharing, and I hope you guys have learned something.